CAKU, sir, shall I proceed?
Yes, ma'am. No issues.
Yes. Okay. Thank you so much, sir. So, good evening and namaskar to everyone who is present here. I am CA Srishti Khanna. So, today I am very glad and honored to
Recording
be
has
the
started.
today's moderator of this wonderful session. So, I welcome all the participants, eminent speakers, and deliberatories who are present here to attend this session, which is on the topic that is Management Accounting Insights, Treasury Management and Technology. This session has been conducted by the Committee on Management Accounting of ICI and is hosted by Akola branch of WIRC of ICI. So now, without wasting much of our time, I would like to invite CAKU sir, the branch chairman of Akola branch of WIRC of ICI, to please give a welcome address to all the participants present here. So, a very warm welcome to you, sir. And now over to you, sir.
Thank you, ma'am. Thank you,
Thank
sister,
you.
ma'am. Uh, Very warm good evening to one and all. It's been a very good, pleasant evening over here. And today we are having this wonderful session on the topic Management Accounting Insights, Treasury Management and Technology, organized by the Committee on Management Accounting of ICA and hosted by the Akola branch of WIRC. At the outset, I would first like to thank the Committee on Management Accounting of ICI, Chairman CA Charanjit Singh Nanda sir, who has given this opportunity to us to host this particular session on treasury management and technology. A very new topic, something which we all need to understand out that what is treasury management. Treasury management, in the general parlance, what we say, it's something about the funds management. But if we look at this current precedent pandemic, it has taught us all that there are some sudden changes and shifts into the demands which come unannounced. The ever changing market dynamics has forced all of us, including the business and the individuals, everyone, to gradually migrate all their financial processes on a digital platform. Compulsory कहीं ना कहीं हो चुका है ये चीज. And this presupposes for all of us to have a very good system that can effectively manage the cash visibility, funding needs, and cash flows. Thus, which will help us all to manage the basic thing that is treasury. And hence, we all are over here for the today's topic that is treasury management and technology. How we can handle all this thing using the technology. On the another side, what we say that technology, when we need to use a technology, we say that there are n number of risks available with everyone, and generally the person who is handling this treasury activity, he faces different type of problems such as the liquidity risk or the price risk, or some times it may even happen the credit risk. So to handle all these things, to spare the time to see that everything goes right, we need a very good important understanding on this particular topic, treasury management. And to leverage all these things, we are also using nowadays artificial intelligence, blockchain, etc., which helps us out to manage out some or the other way to handle treasury. My sincere thanks literally to the Committee on Management Accounting who have taken this session today on this wonderful topic, and my thanks to the entire Akola branch managing committee team who have also joined hands and willfully said yes, that no, we should host this particular session. My again sincere thanks to even today's speaker Shastri sir, who will deliberate his views on this particular today's topic वेरी ब्यूटीफुली एंड डेफिनेटली इस सेशन के बाद में हमारे शायद बहुत सारे क्वेरीज जो होंगे वो जरूर सॉल्व हो जाएंगे. सो विदाउट मच नॉट वेस्टिंग मच मोर टाइम, आई वुड रिक्वेस्ट अगेन सृष्टि मैम टू टेक द चार्ज, एंड थैंक यू वंस अगेन all the members over here for this wonderful session. Have a very good listening and learning. Thank you.
Thank you so much, KU sir, for your wonderful words. So now moving forward to continue this session, I would like to introduce to all of you our today's eminent speaker, Sir T.R. Shastri sir. So I would like to share some brief about sir's profile. Sir is a postgraduate in science and is an associate of the Indian Institute of Bankers of the Chartered Institute of Bankers, London, with the distinction in accountancy. Before joining ICCI Manipal Academy as a dean, since its inception in 2008, he had worked in ICCI Business School as faculty and had worked for long in Canara Bank, both in India and abroad. He has also worked in a private sector bank as a head of international trade and treasury. He has 30 years of banking experience, 3 years of consulting experience, besides teaching experience of over 10 years. He was trained in a leading bank in London and has attended international seminars in Frankfurt, Singapore, and Sydney. His current areas of interest includes HR applications relevant to bankers, international trade facilitation. He is an alumnus of the prestigious International Teachers Program, having undergone the studies of HEC Paris. He was facilitated by the chairman of ICCI Bank during the convocation of 2012. Till recently, he was working as a joint director in the Manipal Academy of Banking. Presently, he is working in industry expert for a finance accreditation agency in Malaysia supported by the central bank there. He has authored the book on FEMA. His hundred of articles has been published in multiple publications and magazines. He has been a regular guest speaker and faculty in leading universities, banks and institutions including the ICI. Sir strongly believes that his name TRS stands for Teaching, Research and Services to the institution. So, sir, it's really, really wonderful that your name is already carrying so much qualities that we should have been, that we could have seen in a person of immense knowledge and intelligence. So, sir, moving forward, I would like to invite you here and to give your deliberation and give your knowledgeable words to us. So, moving forward to you, Shastri, sir. Sir, you are not audible
Sir,
at
you are
this
not
time.
audible. Sir, you are not audible. Sir, please unmute. Please unmute.
Yeah, but the usual mistake, I had not switched on the mic. Now I think it should be
Okay.
okay. Yeah. Okay, thank you very much. Particularly thanks to all the seniors of ICA for giving me this opportunity. And of course, thanks to Srishti for she said a short, brief biodata of mine, but I think it was as long as likely to be my talk. Anyway, thanks, madam. Srishti very nicely did not tell one information about me. I am not a chartered accountant. She did nicely, she did not tell that. Anyway, that's the right issue.
Yes, 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 sir.
I have been working in treasury areas, so it's an opportunity for me to share work at treasury areas and also in technology. A lot of technology migration issues I have handled, got beatings from both the sides, from the vendor and from the management. All that I have undergone. So that to that extent, I have that text. I will share with all of us for the next year. Around minutes or so. Anyway, now that you have seen my face, I will mute the video so that the transmission becomes easier, and I will try to share my PPT. As mentioned, we share this idea for approximately 90 minutes from now, maybe another 10-15, whatever time permitted for the asking question answers. In fact, in a sort of offline class, I would have encouraged question then and there, but of course, this technology, as you know, has its own limitation side also. To that extent, I think we have to manage for that now. Anyway, thank you. I think we will go ahead with this setup. I mute the video and I'll try to share the Madam Srishtikanna, you may have to help in case, just check up whether my audio is you have to keep an audit on that, whether my audio is always continuously audible. Secondly, when I move my PPT, particularly the movement from slide to slide, it is smoothly happening and all. Anyway, we have tested in the afternoon, but then the technology can always give a challenge anytime. So with that, I will start. I will try to share my screen. Is it visible?
Sir, right now it's not visible
No, sir,
to
no,
anybody.
Sir, not yet.
Okay, that's the issue because in the yeah, now I just one minute. Now it should be visible. Is it visible now?
Yes, sir.
Yes,
sir.
yes, yes.
Okay. If I move, for example, is it moving? Should be moving. Okay.
Yes,
So,
sir.
good
Just go
evening,
ahead.
all. In fact, my sort of sympathies to all on a Friday evening, that too between 7 o'clock, 9 o'clock. In fact, when we are supposed to enjoy the evening, in fact, we are all assembled here to learn something or understand or refresh our ideas on treasury management and technology. Also, three very high sounding words and hopefully are interesting for our relevance. So, let us discuss about it because they are definitely interesting and challenging and very current topics. They are very important for us. So how are you going to discuss about this? These are the broad my agendas. Understanding the treasury and treasury management. Of course, we obviously this topic like treasury or treasury management or technology as related to treasury can be discussed for hours together or days together. So what we are going to do is we will try to give an overview of each of the topics so that it becomes refreshing. And we should also know one of the challenges. For example, among the participants, some of you may be already working in treasury area. Some of you may be working in, for example, in the audit of treasury. Some of you may be working in the technology part of it or the audit part of it. To that extent, for example, there will be challenges. For some, it may be completely new. So to that extent, a bit of balancing is required. So what I am going to do is give an overview and hopefully it kindle those of you who are not very familiar with this. Hopefully it kindles you to take it or study it further. Those of you who are already familiar, perhaps it becomes a ground for refreshing our knowledge. We will talk about treasury and its treasury management, understand it for some time. Then we will talk about the technology, whether the role of technology in treasury, to what extent treasury is dependent on technology, what support technology is giving in treasury. What are the regulatory expectations? Remember, treasury is one of the areas which is highly regulated. Why it is regulated, we will see it later. So apart from that, regulator therefore expects a lot of support from the technology that has been implemented in the treasury. So there are certain regulatory guidelines and expectations. And of course, the latest challenges we also have is about the instrument. We have a lot of challenges in handling our usual routine assets like class of assets like, for example, the government securities, money market instrument, foreign currency security, etc. But then we have a set of new types of assets that are coming into the market. The digital assets like the cryptocurrencies or the non-fungible tokens or CBDC. In fact, the CBDC is quite a popular topic after it has been mentioned in the budget. So these are the new types of assets to which the treasury is likely to access. How exactly treasury technology is going to handhold us or support us in these. So that's what we will try to briefly see the future of it. The security challenges. Okay, once we say technology, it has its own challenges like, for example, the cyber security issues, cyber attacks, all that and all, hacking and all. We will, it's a big subject by itself and all, but what we will do is, so I will take up one or two examples specifically as applicable to technology hacking in treasury. That's a treasury technology area. What are the challenges? We'll take one or two examples. Then of course a fintech is new thing, something which is coming, which is trying to help a treasury, but as the word itself says, it is highly technology intensive. So what is the technology support that is available for fintech applications in treasury? We'll try to say it briefly. Algo trading, you must have heard about it. Trading, that is basically a part of treasury, but using robots. That means human beings are not there. Algorithmic basic trading. That means if you build a logic and how exactly the trading can take place automatically. So we'll try to see briefly what is the impact, what is it actually it is going to do, and then what is the role of technology in that. Having studied all that, perhaps what is most important for all of us is, for example, okay, this is fine. I'm sitting from 7 o'clock now. In fact, what is it actually? It is interesting to me. What is it there for me? What is in it for me? That is what is important. Who am I? I'm a chartered accountant. Maybe I'm in the audit work, or maybe I'm related to treasury, or I have an interest in getting into a treasury portfolio or audit portfolio. How exactly all these 2 hours or 1.5 hours of discussions going to help? That is what we will see. So we will see what is the role of audit, what is the scope for audit in this area of technology as implemented in treasury. This is what this broad agenda coverage is. Maybe, as I said, it's quite a broad area. We are trying to give a brief overview of the essential topics here. What is treasury? Treasury used to be a part of government earlier, managing money and revenue. If those of you who are reasonably young, perhaps if you ask your parents, they will say treasury means something like a corner office in some government building with the 40 watts bulb, with some old wooden tables and chairs, where you have to stand in a queue, you want to pay money. So it used to be so difficult task even to collect, even to pay money to the government, it used to be it used to be a difficult task. And we called that as a treasury. Of course, that was a long ago. But now treasury has become a part everywhere. For example, there is treasury even in Treasury is a part of non-government entities also. For example, in financial intermediaries like banks, NBFCs, mutual funds, insurance companies, all these regulated entities, financial intermediaries, obviously they have treasury. I have mentioned the word banks in a color, not because I am an ex-banker, but because banks have a most important role among all treasuries. In fact, for many of you who are not very familiar with treasury, the moment we tell about the word treasury, perhaps the word bank will immediately come into the picture. Because treasury means we almost try to identify it with the bank, because there can't be a bank without a treasury. That type of situation. There are treasuries in corporates. In fact, larger MNCs, corporates, even large number of Indian corporates have got their own treasuries. Basically, because in fact, some of the treasuries of some of these corporates are actually bigger than some of the treasuries of some of the banks. They are quite large. Basically, because the corporate treasury volume, depth, complexities are quite large. Family offices of HNI. So, for example, if you talk about any of the founders of Infosys or any HNIs, they have their own family offices. The total assets managed there are fairly large, which requires a separate sort of set of people and an office or a policy to manage that. So what is meant to manage? That's what we are going to see. Many corporates carved out treasury out of finance department. Treasury, it is not that treasury is there in every corporate, or that it's only treasury is there. There can be a company, as and when it starts, perhaps it will have finance department, but then it carves out a treasury later. Why? When it is required, when the depth and complexity of challenges increases, then it calls for a treasury. Think of a company like this. Say, for example, a 500 crore rupee turnover company. It has no imports, no exports, it has no foreign exchange business. Whatever surplus is there, its management is very conservative. It thinks that it is best to keep it in fixed deposit. If I have got a surplus, I will keep it in fixed deposit with my public sector banker and nothing else. Then perhaps it does not require a treasury at all. No specialist requirement is required. The management has taken a deliberate decision not to diversify its assets class. Not to diversify its assets portfolio. It's okay. It's its own decision. Nobody can question the management decision. So it has taken a decision like that. Then does it require a treasury? Obviously not. But think about another 500 crore turnover company. It is fast growing. It is thinking of raising a euro currency loan for its expansion and not a rupee loan, because it thinks that the terms and conditions are better, the exchange risk is manageable, interest rates are much more attractive, etc., etc. It has imports and exports in different currencies. In fact, it is thinking that I should not only make profit out of my sales, in my invoice price should necessarily have a 10% profit, but more importantly, I should also be able to take good benefit of movement of exchange rates, movement of interest rates, covering the exchange risk, etc., etc., and all. That means it is trying to take advantage of, or rather gain benefit, may take benefit or make profit out of the money. Not profit, not merely out of the commodity it is selling or buying, but more importantly out of the money it has generated. So that means it really requires a treasury, because basically what is treasury, as most of you know, it is nothing but a place where money is being traded. A treasury does not handle in, for example, iron ore or garments or pharmaceuticals. That is a company's core business. But out of the funds generated out of it, or the funds required for the company, the treasury makes an important contribution. So its raw material itself is money, and hence where there is a complexity, obviously treasury is required. Complexity means when there is a possibility of making profit out of it. What is the reason? For example, if you think about some 30 years ago, no corporate had a treasury, because basically there was no requirement. All loans were taken from either financial institution or a bank. All rates of interest were fixed. May not be 30 years, maybe 40, 50 years ago. Even everything was fixed. Then there is something like a necessity or more understanding or trying to make profit out of the money. So then what happened over a period of time? There was a deregulation in the banks. In the sense, banks' rules and regulations were deregulated by the regulator. Banks were given freedom, not only in the rate of interest, but also in the types of products it can offer. There is a competition in the capital market. What does it mean? There are a variety of instruments that are available in the equity market. It's not simply the equity which is available, that is something like, the shares or the debentures, the equity, the preference shares or that type of thing. There are a variety of instruments that are available in the capital market. There are different options in financial instruments and partners. That means if a company wants a loan, it is not only the financial institution, the banks which are ready to give loan. There are specialized financial institutions for equipment finance or housing loan or this, that, and all. There are a variety of instruments available. There is electronic trading platforms are available where you can raise finance against the receivables, etc. So that means there is a bewildering options available among instruments and partners. There is the impact of technology in delivery of these treasury services. Banks, the way in the bank offers services to the corporates or to the customers has changed substantially, because there is a freedom to offer it directly. For example, if a Swift terminal itself can be made available to the corporate. So there is the technology has impacted even the delivery of services by the corporate. Treasury needs are to be managed. What is meant by treasury management? It is managing the treasury. What is meant by managing? The requirements of treasury are to be managed. That is why it is called as a treasury management. Otherwise, the word treasury management was not required. You could have simply called it a treasury. But then it has to be managed. What is meant by managing? The managing basically talks about we should understand what is an objective of treasury management. We broadly understood what is treasury. That means treasury is not the finance department taken out of it, carved out of it, and a department or a set of people who raise funds or who make available funds or deploy funds, etc. They try to use what are the alternatives available in the market, so that they try to take benefit out of money. So that means the objective of the treasury management is basically something like this. You can read it, you understand that. Treasury refers to a set of policies, strategies or transactions a company adopts and implements for what? Basically for three purposes. There is nothing more. There is no socialism in treasury. Even for a public sector bank, there is no socialism. There is no sort of CRR like things. 10% of your profit should be out of these, 20% of the profit should be from small scale industries, 30% should be, etc. Nothing like that and all. It is a free play. So in that situation, either for a corporate or for a regulated entity like a bank, the treasury objective, one of them, is to raise finance at acceptable cost and risk. What does it mean? When the entity requires to raise funds, it should be at an acceptable cost and at an acceptable risk. For raising finance, you may think, what is an acceptable risk? Risk basically it means the lending institution, is it acceptable to you? If you are a 5,000 crore corporate entity, I don't think you would like to deal with a cooperative bank. Even if the cooperative bank offers a rate of interest on a loan at a lower rate than a public sector bank or another commercial bank. Because basically the counterparty, you want it to be at your level. That's a silly example. But like that, for example, the terms and conditions offered for that finance may not be acceptable. So the raising finance at acceptable cost and risk. Cost does not simply mean, for example, the rate of interest of 7.4%, 1.38%, etc. Cost means including all, for example, the exchange risk, the forward cost, or for example, the options available, all types of hedging costs, etc. All together, what is it that the net cost that is available? How to raise the finance at an acceptable? Is it raising finance in India or outside India, in this currency, that currency, for short term, long term, etc. All those aspects together. If I am in treasury of a corporate which wants to raise finance, my first objective is to raise finance. If the company wants to raise finance at acceptable cost and risk from 100 variety of sources, from whatever sources acceptable, this subject risk. Second is, on the other hand, if I am in a corporate which has large surplus, for example, I am in the treasury of a software company having large surplus, my objective then is to manage a cash resource. What is it to managing? To optimize the yield on my resources, my surplus. The basic concept or the most first step would be perhaps to keep it in a fixed deposit in the bank. Your net of yield without much risk, depending on the bank, much of risk, you might get some 3-4%, etc. But then obviously that is not what a corporate looks for. So there are different varieties available. It could be invested outside India. It could be invested in different currencies. There are provisions available. There are provisions you can make available. For example, you can put it in the money market instruments and variety of other instruments available. It could be intercorporate, etc., etc. How do you optimize the yield on the resources? That is the second objective. Mind you, this is for a corporate, but for a bank or a financial intermediary, the bank may be actually raising finance and also having surplus at the same point of time. The treasury dealer may be borrowing in the interbank market for the purpose of lending, or it may be simultaneously one dealer may be raising funds, another dealer may be deploying the funds, because it's a continuous activity which is happening, because each activity by itself making a small profit to the treasury. So, but on the each activity, if it is raising finance, optimizing the yield, if it is raising finance at an acceptable cost and risk, and then of course to manage all types of risk within the acceptable risk, that means within the so-called risk appetite of the entity, corporate or interrelation, a bank, etc. There is a risk management policy laid down by the organization, bank or a regulated entity or a corporate, and this entire management of the treasury, entire handling of treasury, every moment of every minute, every time, every day, it has to necessarily be adhered to the policy. That means within the credit risk, within the counterpart risk, foreign exchange risk, the variety of limits stipulated, etc. So that means risk management, the cash management, and also raising finance. They are the broad three activities of a treasury. In other words, as I said, this is again a summary, to have the funds in place as and when they required. As and when they required. For example, a company raises equity, either here or for example, ECB, or it may be ADR, GDR, whatever it is and all. When do you raise the funds? Maybe I raise the funds now itself for my deployment. My factory is coming up and the machineries are imported in the month of November. Should I raise the funds now or in the month of November? If my treasurer is so good, he thinks that it is worth raising the funds now because it is available fairly at a reasonable cost, and in all probability I will be able to deploy it in a market and then raise funds. raise yield on that, subject to control regulations allowing. Perhaps then I will raise the funds now itself. So therefore, raise the funds or have the funds in place as and when they are needed. So if I have surplus, the treasurer should ensure that don't put it in money market or some illiquid investment because the yield is high, because the funds may be required in the next 15 days. So like that. For example, if in an interbank market, funds may be required next day, on a next working day. It may be term basis, it may be spot basis, etc. On the tomorrow basis or second working day basis, etc. So I should be able to manage the funds in such that they are made available as and when they are needed. As and when they are needed, I should be made available, and when they are not needed, I should not keep it lying idle without raising funds. That is what the right management I will do it, to put all cash to best use. All surplus has to be put in best use. I put the words cash and best use in red ink. Basically, you understand what is cash there. Cash is not obviously the physical cash, what the cash, the balance, basically the liquid assets or the receivables. So that is what the good receivables. That's what mean by what we refer to as the cash. And of course, what is best use? As I use the word often, it is optimum return, and if it is raising funds, of course, minimizing the cost. That is what the objective is. So in other words, broadly we can, from a corporate angle, the functions of treasury broadly are, one is liquidity related. It's the same thing what I discussed from a different perspective. Cash forecasting, gaps, concentration. What's not a concentration? I have surplus of 100 crores. Obviously the X bank is giving me good rate of interest, but I don't think I should keep all the 100 crores in X bank. I should not keep all the 100 crores X bank in, for example, in this particular maturity period. I should not put the entire amount in all my surplus in particular the class of assets just because the yield is expected to be more. The concentration. This concentration limit or the gaps, etc., this should be controlled through my risk management policy. So every treasury of a corporate or a regulated entity should necessarily have a risk management policy before it starts its operation. That's a day one requirement. It's a regulatory, mandatory requirement. Center-wise, currency-wise, I'm in a corporate having units in 2, 3, 4 centers in India, outside India, managing the currency, the surplus available at those places, currency-wise surplus. We have, for example, think of a bank. There is a bank, let us say, which has got large number of branches in centers where there are a lot of non-resident Indians. What happens is, in all probability, its foreign currency resources have a lot of surplus, but it may not have borrowers who require foreign currency borrowings. It may not have such corporate borrowers at all. It may be a small bank working in sort of residential, non-resident pockets of non-resident Indian pockets in India. So then what happens is, it has got a currency surplus. It does not have a scope for deployment. In case of a larger foreign, you think of a foreign bank which has opened, say, 4 branches in 4 metros of the country. Maybe it has large FCNR deposits or foreign currency deposits, but its corporate asset portfolio may be much higher. So it may be in a situation where it has got shortage of currency. So currency management itself, the center-wise management, currency-wise management, working capital management, receivable payable management, all these are broadly the functions of treasury. So receivables function, receivable payable could be a function of treasury, but frankly speaking, the distinction of an activity between treasury and finance may not be very sharp. It may be a bit blurred, depending on the corporate, depending on its own activity. It could be defined individually. I mean, it is not a sort of legally definable item. Capex related, for example, investments, borrowings, merger and amalgamation, fundraising, currency wise, center wise, etc. etc. For example, a company decides that it will set up a subsidiary. It will set up a subsidiary for its core activity outside India because it has got some its own reasons. So the treasury can advise, is it advisable to put up that unit in Indonesia or in Kenya or in, say, for example, one of the European centers because of the following reasons: currency movement, the local restrictions, the taxation aspect, etc., etc. So even a investment outside India, treasury plays a large role. Obviously, treasury investment in India also. The treasury comes into the picture. Treasury activities come into the picture. Risk management is there, long term, short term, choice of currency, asset liability management. I was giving an example of a currency, something like that. Short term liability, long term assets, vice versa, etc. Managing different types of risk, market risk or items. Because basically, please remember that treasury is one place where lot of market risk gets generated. In fact, for a regulated entity like a bank, the entire market risk of the bank is concentrated on treasury. What is market risk? Risk arising on account of market fundamentals like interest rate movement or exchange rate movement, equity price movement, etc. They are all handled at treasury, not at the branches of the banks. So the market risk ownership generally lies with the treasury. IT systems, which is going to be topic of our discussion today. External relation for a corporate is also like with credit rating agencies, banks and financial institutions, other stakeholders, regulatory reporting. All these are done by treasury. Why banks and financial institutions were relation? Basically because even if the treasury is fairly large for a corporate, the advantage of a bank is not available for a corporate, a treasury. The advantage of the treasury of a bank. For example, the exposure to the outside market. And a simple thing, for example, let us say you are working in a large pharmaceutical company. You have your own treasury. You want to know what the other treasury, the treasury of another pharmaceutical company is doing. Obviously, you can't get it that easily. On the other hand, if you and the other company are dealing at least partly with one common bank, during your quarterly meeting with the treasury of the banks or with others, you may get some idea about what are the strategies used by others. I'm not saying it's a good practice or bad practice, but I'm telling to get to know what is the market functioning or how exactly the market is happening. This becomes the external relationship or maintaining a relationship with banks, a financial institution becomes important. Similarly, for example, stakeholders, investors, regulators, etc., etc. All that in a bank, these are all handled by different departments, but usually in a corporate, the treasury handles all these. So these are the broad functions of treasury. So having broadly understood what are the functions of treasury or what is meant by a treasury of a corporate or of a regulated entity like a bank, I think some of the characteristics we can easily identify. One is it is a high volume, low number business. What is meant by that? For example, there may be a corporate which may be raising some 5,000 invoices per year in its sales business. 5,000 invoices. Whereas the treasury of that corporate may be actually having only, say, for example, some 250 transactions per year, buying and selling transactions, or investing and selling its investments, etc. Or, for example, in a bank, the treasury may be handling, say, for example, 100,000 crores, 1 lakh crore business treasury. The total deposits or advances of the all branches together may be also be approximately same. But you can think of there may be some 500 branches of the bank, whereas there is only one treasury. There are only some 20 people handling the treasury, whereas there may be some 500 or 1,000 staff members handling all that 500 branches. So that way, the number of transactions is less, but the volume is more, which automatically means that the volume per transaction is extremely high in treasury. It is, for example, if somebody keeps a deposit of, say, 10 lakh rupees in a branch, for the branch manager, for most branch managers, for example, he is a fairly good or a reasonably large depositor, perhaps he deserves a cup of coffee. On the other hand, if somebody says, I am going to invest 10 lakh rupees in interbank market, most other counterparties will say, sorry, this is much, much below my standard lot, and so, sorry, no entry for you. Forget about giving coffee or no entry at all. So, that I mean, just as a casual example I'm giving, but the transaction volume is per transaction is very large. Reaction time is quick. What does it mean? For example, if you go to a bank, as an individual, if you go to a bank and ask for a home loan, I don't think you get a loan in 5 minutes. I mean, you may get an in principle even on machine. But then, for your actual dispersal, it requires a lot of documentation, sanctions, terms and conditions, etc. It may be a question of 2 weeks, 3 weeks, even for the fastest bank. On the other hand, in an interbank market, a transaction of $1 million, that means something like a 7.5 crore rupee transaction, that is, I lend 7.5 crore rupees equivalent of dollars, $1 million loan to another counterparty bank. My decision time is hardly, say, for example, 5 seconds. Oh, this rate of interest is okay, this counterparty is okay, I lend. And the other party confirms the deal is done. So the reaction time has to be very fast, whether I should accept it or not. I mean, there are some already laid down fundamentals, like, for example, the counterparty is already assessed and then limit has been fixed, or, for example, ISDA agreement has been obtained, documentation has been completed, etc. But subject to some basic sort of platform already being set up, the reaction time is very fast. It has to vary. This is a characteristic of Treasury. The concept of short term, medium term, long term itself is different in Treasury. What does it mean? For example, in a normal sales activity, for example, when you say medium term or even some medium term, it means something like the 6 months. Usual credit we offer on sales is a 6 months credit, 180 days credit. So that could be a medium term. A term loan is taken, a loan for a machinery is taken for a long term. What is long term? It's around 3 years or 5 years. What is short term? Maybe, I will give you overnight lending, say, for example, 3 days, 5 days, something like that could be short term. Now, generally, I mean, these are not legally defined words, but that is what a general understanding in a business context. Whereas in a treasury, short term could be maybe 1 second, 2 seconds, 3 seconds. Medium term could be maximum, say, for example, a few minutes. Long term could be next day, second working day. So the concept itself is different, which means the reaction time pressure is much higher. It is highly regulated. Why highly regulated? Because the volume is large. See, in case of regulated entities like banks and all, the treasury can create havoc. The treasury can give direction to the movement of rate of interest. If, for example, some 3 or 4 large public sector banks try, for example, start purchasing dollars right now, what happens is obviously the dollar premium, dollar price goes up in the spot market. So the bank said, so market, this is about the exchange rate. Similarly, for example, if there are large number of banks who are lending, that means the rate of interest will come down. The call money rate could fall down and all. So the market movement itself gets determined by the treasury, not by, for example, suppose all of us go together today, at the same time you go to the bank and deposit 10,000 rupees, 20,000 rupees, 1 lakh rupees, interest rate does not just move at all. Look at our amount, so small. So that means the treasury therefore can create a real impact on the money market, on the economy. That is why the regulators are highly interested in this. So it's a highly regulated area. I mean, apart from many other reasons, for example, the risk, it could create a systemic risk. If, for example, if one bank fails because of the treasury mischief, there are lots of such incidents. The banking system could collapse. That is why the regulators control the treasury fairly high, rigidly. Globally accepted structures, for example, to avoid all the risks, etc., there is a structure called front office, back office, mid office. So many of you are either familiar or perhaps most of you have heard about this. Basically, I mean, front office does not mean that it is sitting in front of the building and back office is the back of the building, and not as don't take that casually. But basically, it means the work handled at the 3 areas are different. There is a clear Chinese wall, I mean, a sort of rigid separation of duty between the 3, or at least between the front and back office, so that the control or the chances of something going wrong are reduced. The control is higher. Time-tested process controls are there, including, for example, this word which may be very pleasing to you, including audit requirements. We'll talk about it a little more because that is a subject very close to our heart. Time-tested process controls are there. Large number of technology-intensive service and input providers are in the treasury, like, for example, the Reuters, Bloomberg. You must have heard about this. In fact, Reuters provides platform for trading. It provides the current information supplier. Bloomberg also similarly. Swift, for example, is a channel, is a sort of closed user group which facilitates movement of funds between the banks, between the users of the closed user group across the globe. Multi-currency, multi-assets portfolios are available, and because the rates are varying, what rates are varying? Interest rate could vary, exchange rate could vary, commodity price could vary, equity price could vary, everything could vary. All those lead to market risk. Therefore, there is a valuation challenge happening, and there's a fundamental part. Of course, valuation challenge could lead to valuation surplus. That is the reason why Treasury takes position and trades in currencies and activities. So these are all possibilities. So that is why Treasury has these are the broad features. I mean, this is all broadly we try to understand about what is Treasury. I mean, those of you who are absolutely familiar with the Treasury, what I have said is very basics, maybe a refreshing of that. Those who are absolutely unfamiliar with Treasury, perhaps, it becomes something like, opening of the mind. Maybe I hope it will evince, it will nudge you to take further, interest further. I guarantee you that Treasury is an extremely interesting area. There is no doubt at all. So please take interest, it will be useful. Having understood what is Treasury, now we will talk about the second. We try to understand Treasury. What is summary of what it is? It is a part of the corporate or part of the regulated entity like a bank, which deals with money, which deals within the short-term market or medium-term market, etc., money market, foreign exchange market, etc., etc. It buys and sells those instruments with an idea to optimize the profit. If there is a surplus of the corporate, it tries to deploy it and optimize the profit. It has got, if it requires funds, maybe it tries to help, it tries to involve in raising funds at an acceptable cost, accept risk, etc., etc. And overall, the risk management arising out of this, basically market risk management is handled by Treasury. Having understood that, now the next question comes: can you manage a Treasury without technology? Does it require technology? Obviously. In fact, nowadays we will not be. Right now, for example, I am not able to, or perhaps we are not now accustomed to listening to a session without a PPT. If you think PPT is a part of technology product, technology is essential even for this simple activity. Without a technology, now nothing is available. But having understood the possibilities or complexities within Treasury, I think need for technology is something taken for granted. Obviously, it's not a brainer. It does not require further discussion. But next question comes: what are the expectations from technology? Now that, let us say I am a corporate, I have set up a Treasury because I have got from 500 crore surplus, and then I have recruited some people who say they have been working as treasurers in this bank or that corporate, etc. So they are going to raise my yield on my surplus from the present 3.5% net of tax to, let us say, 6.5% net of tax. So then, okay, all right, Treasury we set up. But then he also says it requires a technology. All right, we purchase a technology solution from vendor for a Treasury. But then what do I expect from the technology? Upfront, what do I expect? What are my expectations? Okay, it helps me in all these communications. It helps me in neatly maintaining the accounts. It's their basic requirement. But having invested in technology, obviously my dil mange more increases. My dil mange more. What does it mean? I would like to take advantage of the opportunities arising from removal of barriers and ease of communication. This is a very nice word of telling. I want to make more profit because of the technology. That's what it means. Why more profit? There is a removal of barriers. What does it mean? It means there is a liberalization in commodity trade, import, export, etc., services, movement of funds, movement of capital. That means I can invest outside India, I can invite an FDI, all that type of movements are allowed. So how do I take advantage? Hello, Treasury Manager, please help me in that. Use the technology, find out what are the best possibilities, prepare a sort of Excel out of it, and to explain to me how exactly my investing in Kenya and invoicing in euro is better than investing in Indonesia and invoicing in dollar on a 3-year basis, 4-year basis, etc., etc. So I start expecting all that from my technology. Rupee loan or versus ECB loan or credit, buyer's credit or a cash credit availing in rupee here, which currency I should invoice, how should I manage the funds. There can be multiple type of questions. I start expecting Treasury using its technology to help in all these. Collate the positions and manage resultant exchange risk. I am a corporate having branches all over the at many multiple metros or perhaps in different currencies, different countries, etc., etc. Treasury software should be able to help me in collating all that and manage the resultant exchange risk That means, the by counterparty risk, exchange risk, all types of risk I should be able to do it. Handle increased responsibility of KYC. What is going to be KYC? You know about it. But KYC, we thought it's all bank's responsibility. But remember, if I'm in a corporate, some part of KYC is coming to me also. I am expected to be a good take care. I should take care of the KYC of my counterparty. For example, just because some good investment is possible in a country which is banned under FAFT, that means that Financial Action Task Force, FATF, and not FTA, FATF. I found out I should have that is why, in fact, for the last around 3-4 years ago, globally a new concept has been introduced called LEI. Think of it, what is LEI? I will tell you what it is after a minute. Think of it, if it comes to your own mind, it's always better. Decision taking. What is decision taking? I was earlier asking my banker, can I do this or can I do this? What do you think the interest rate will be? What do you think will be exchange rate will be, etc. But now there is no asymmetry of information. That means there is a symmetry. The banks and corporates have the same price information at the same time. That means I am expected to take a decision on my own because banks are unlikely to give something new information other than what I can make out from the market information available. So my responsibility has increased in decision taking, in these financial decision taking. I can't depend on my financial advisor. I should be able to do it much better. I should be able to manage competing environment for added profit. These are all my expectations, profitability wise or legal regulatory wise. What is LEI? LEI stands for Legal Entity Identifier. I think many of you know. If you are working in a corporate or a bank, you know it. In fact, for all transactions, you should mention about it. Regulatory compliance, there are a lot of, as I said, there is a lot of regulatory expectations. It's a big chapter by itself and all. Technology should be able to help. We will talk about it a little more in the next couple of slides. There is a budgetary pressure in the sense, like, for example, any investment on a machinery, building, etc., even on investment and technology, my management will ask for it. What is the ROI you are going to give? Last year, my profitability was, say, for example, for so and so percentage. Because we have automated it, we have brought a wonderful treasury software. Can we raise the yield from 3.4% last year to 3.8%, etc.? What is the extra incremental ROI because of the investment in technology? That's what the management is asking. So it is not sufficient if I optimize my revenue, I should be able to justify it with commensurate with the investment on technology. So that is why expectation on management, expectation on the technology, on the investment in technology. Support other departments, like I said, so for example, invoicing currency, or say for support setting up of a new unit in Indonesia, etc. Or for example, if you are thinking about a foreign collaboration, is it worth inviting their investments, this percentage, that percentage as ADR, GDR, or as an ECB, etc., all type of situations. The finance department or the management or the CEO's department may be thinking about it as a treasury. I am expected to help or give ideas. I should use the technology and help them so that I give a different Excel chart and compare and tell them what is it advisable and all. What is the process control that technology? As I said, treasury is a highly sort of, in a way, it's sort of what we can think of as a live wire situation. Yes, the treasury could make large profits, but it involves decisions on large amounts. So obviously there is a large risk, a large loss also possible. So some sort of process control also has to be done, and I should be able to get a good support from technology for that purpose. So this is what, in fact, in the entire treasury, if you study the treasury management as such, there are umpteen number of methods in which some sort of controls are being laid down. For example, about the risk management policy document, or it may be the variety of control limits. It may be on the working hours. It may be on the counterparty limits, etc., and all. So one of them is process control. That means the way in which the process happens within treasury, it has to be controlled. It is sort of time-tested processes are there, and the technology should support it. One obviously is the functional separation between, I think I mentioned about it, between the front office and back office. The front office people and back office people should have separate login credentials. There no way, for example, they should be able to access each other's, etc. And more importantly, the flow of information from front office to the back office. That means, the dealer or the front office person has put through a transaction, let us say a buying of $5 million from another bank, validate so-and-so, rate, interest rate so-and-so, or something like that of such transaction, or an investment of 50 crore rupees investments in some company or some intercorporate, etc., or in a money market instrument. That information should flow to back office without a human intervention. That means After the transaction is put through, the dealer or the front office person should not be able to do any tampering in that, to any manner, changing in that. He or she should not be permitted to insert a deal, add a deal, etc. Deal numbers, time, rate, amount, etc., should be captured by system. There should be no provision for changing. It's not alterable. As such, it should go to back office, so that the back office has a control, and thereafterwards, what the back office does, it asks for a counterparty confirmation, so that in the dealer of A bank or dealer of A corporate has done a deal with the dealer of the B corporate, the back office of A and back office of B exchange counterparty confirmations. So that is enabled through technology. Aggregation, of course, instead of the individual, there could be aggregation of what is called aggregation or netting of payments. For example, if you are in banking related, there is an organization called CCIL, Clearing Corporation of India Limited. So what it does is, instead of, say, for example, individual banks, if there are 100 banks, if they are put through some, say, 20,000 transactions, it's not that all the 20,000 transactions are settled. It's the securities or foreign exchange securities or rupee securities or the funds do not move on 20,000 times. It is all netted in between, an object, what you call CCIL comes into the picture. All those contracts are replaced by, or a netting by novation takes place. A new contract with CCIL takes place. I mean, it's entire thing is managed through technology. Similarly, for a corporate, there is a concept of in-house banks. I don't know how many of you are familiar. Of course, it is not very much prevalent in India, but then in the next couple of years, surely it will happen. Over the outside the, in the globe, in Western countries, many large corporates use it. See, situation is like this. Let us say you are a corporate and having some 4 or 5 divisions, each of which deals in different commodities or different types of transactions, each of which would like to have its own bank account so that it can operate. Or, for example, it has got 4 geographies and 4 different currencies, etc. Then what happens is, the number of transactions in the bank increases, the transaction cost increases, there could be unnecessarily float, unnecessarily overdrawing, etc. So many large corporates, what they do is, they create what is called as an in-house bank. As if a bank has been created within the corporation, within the organization, where all these divisions put through their transactions. This central entity, it is not a bank for the public, it is only a bank for the entire corporate. That central entity, so-called in-house bank, the netted amount it puts through to the bank. So the number of transactions which hit the bank books is very substantially reduced. So there is a concept of payment on behalf of, receipt on behalf of the different divisions. It's called as POBO, ROBO or something like that. All those ideas are there, which basically all these are manageable only through technology. You can visualize reconciliation issues, etc. and all. The errors, wrong entries, etc. All those obviously can be managed only with technology. And when the number of transactions is large, obviously such sort of optimization economy is required. So in-house bank does that netting of that for the corporate. Access control I mentioned to you, that means without access control, that is to use a login password or credentials, etc. The different office or back office person cannot happen. A usual very basic requirement. There is a concept of 4 eyes principle. You know, heard about it. It's a very nice way of telling. What it basically means is maker checker concept. Somebody puts through a transaction, somebody else authorizes, so that possibility of a deliberate mistake or a oversights are reduced. In case of particularly international transaction, like for example, a swift remittance has to take place, then it is not 4 eyes, it is 6 eyes. And then the sense somebody makes a transaction, puts through the transaction, somebody checks the transaction, somebody else authorizes it. So there's one more layer of authorization or checking. Why? Basically because once a remittance goes out of the bank, once it goes internationally to somewhere else, it is almost impossible to keep a control over it or to get it back if something is wrong. So obviously 4 eyes becomes a 6 eyes principle. So these are all process which can be achieved only through technology. In the sense, a technology will not allow, we should not allow a remittance to take place unless 3 people have authorized, 3 people have put or very crudely speaking, 3 people have given their head. In the sense they have authorized, one as a maker, another as a checker, another as an authorizer. Or if it is the 4 eyes principle, one as a maker, another as a checker. So all those are achievable only through technology. So it's a process control. Internal and regulatory reporting. Internal reporting to the management, regulatory reporting to the regulators, etc. Obviously, it's a basic requirement. Any MIS engine can do it, but that is a part of the treasury technology. That technology has to Once originally, for example, the logic or the algorithm has been clearly laid down, that the automation should enable, for example, accurate reporting and then dumping the statements or reporting in an understandable, acceptable way. And obviously, the dil mange more, either the regulator or the management is likely to ask for this change, that information, etc. So the technology should be able to update it and give it as and when required without a murmur, without any compromise on accuracy. So that is what the requirement will be. Just to summarize, for example, this is a summary of chart on a Ernst & Young's website. Perhaps you can see it also. The requirement of treasury and technology are evolving. For example, the new regulations are coming, new tax regimes are coming. The way in which taxations are changing, so that should get changed in the order. Technology should help it. In-house bank, I mentioned about it. Better information, MIS has to be there. So pressure ROE concept is increasing important risk, etc. All these are straight through processing. For example, the left side, the middle one. What does it mean? Some of you may be knowing about it. It means without a human intervention, the transaction should take place so that the errors are, one is frauds do not take place, or second is errors do not happen. So straight through processing is always better. So people think about a 99.6 sigma STP. That means, in 100,000 transactions, maximum one error can take place. That type of accuracy people are aiming at. So that's what is expected out of the technology. Technology should be not only perfect and rigid, it should also be usable. It should be user friendly. That's what the expectation will be. Technology also has some of the changes in the way in which you look at things. For example, you must have heard about cash management services, or there is a concept called lock boxes. What is lockbox? Basically for collecting the receivable checks. For example, if you go to some of the ATMs of some banks, you would have seen some boxes where you can drop your check for a credit card payment. It is nothing but a lockbox. It's a box having a lock. So next day, for example, somebody of the representative collects the check. It is nothing but a box used for collecting receivables in the form of a manual check. Or for example, in EMI check, if at all EMI is accepted as a check. Products like CMS, cash management service, something like receivables management, cash receivable, cash management from vendors, etc., different branches. You have heard about it. All those concepts are slowly becoming less relevant, basically because most payments are now done automatically, electronically. Instead of a check, we expect a EMI standing instruction, so that it is collected on the due date by debiting account electronically. CMS is almost gone now, basically because most payments take place through RTGS, and then somebody sending a check by post or courier, obviously is a lot of people matter now. One more thing, the new technology. In fact, KU sir was telling about it, blockchain technology for being used and all. Mind you, what is blockchain? I do not know what is blockchain. Perhaps some of you may be knowing, but broadly we have some idea that is something like a distributed ledger. What does it mean? The different parties to a transaction have access to the same software. That is my crude understanding of the software. So what does this mean? If I am a buyer sitting in India, and if there is a seller sitting in Germany, what happens the moment we enter into a transaction? I want to import, say, 100,000 euro of some goods. I also agree for 100%, 10% down payment. That means 10,000 euro is payable. In the normal course, what I will do, I will tell my finance department, remit 10,000 euro, etc., etc. Now, if all of us are operating on the same software, the moment I am authorized to sign the contract, automatically it will also enable 10,000 euro being debited to my account and getting credited to my seller's account immediately, and he knows about it. That means the float in the system is gone. Similarly, for example, a dividend warrant, or for example, from receivable, payable, etc. In an electronic payment, floats are slowly vanishing. But if there is a blockchain transaction, blockchain technology that is being adopted all across, some of the new private sector banks have adopted blockchain for their trade finance and all. So what it also means, when it is fully implemented, what it means is almost the float concept itself is completely gone. Real-time global integration between finance and business operation takes place. As I said, I am as a purchase manager, I am very familiar with my business operation. I am not familiar with finance. But now the finance and business operation gets integrated. So the moment I sign the purchase contract and then agree for 10% down payment, that automatically the company's account gets debited and the payment goes to the vendor's account. So the transaction begins immediately. The float funds, the delay in time, all those are vanishing. Of course, it's still evolving. There are exchange control regulations, there are checks and balances to be built in, etc. But remember, this is what it is going to likely to happen. Remittance has become easier. You know about it. Checks, clearing system, all that are gone. High value check. Have you heard? I don't know whether you heard about high value check, high value clearing. All the concepts are gone. All talked about P. You talk about Google Pay. You talk about RTGS. You talk about NEFT, etc., etc. It's all you think about it, and the money is gone. Sometimes it is scary. Multilateral netting. I mentioned about CCIL. Similarly, in a global arena, there is a concept called as CLS, continuous linked system. What it means is it helps settlement among large banks in the global interbank market, in the foreign exchange markets. I mean, we leave it at this stage, but it's almost the equivalent, and not exactly, something similar to what CCIL does within India. Implications on the counterparty bar. If you have heard about what is called as a start risk or a pre-settlement risk. What is a pre-settlement risk? It basically means before the transaction takes place, we have agreed. Say, for example, a bank, I'm giving an example of bank becomes easier for me to explain. I think you can visualize it for a corporate. A bank has agreed to buy some $100,000 from B bank and pay equivalent, let us say, euro to B bank. But A bank has paid the dollar, but before it receives the euro, if the B bank fails, then there is a risk for the A bank. So it is called as a counterparty risk, a pre-settlement risk. Before the settlement takes place, that risk can happen and all. It's also called as Herstatt risk because there was a bank called Bank Herstatt in Germany, which faced this, and hence its name became embedded into this risk. So that the concept, that counterpart risk itself gets substantially almost eliminated, because if all banks are working on a single block, in a single software like what is called as a distributed ledger or a blockchain, perhaps even that risk will get eliminated or reduced substantially. With all this technology, with all this, what is becoming obsolete, against that, mind you, the volume increases substantially, because we will be able to make a lot more. I don't have to spend time in routine book maintenance, etc. Things get automated. So the business increases substantially. Interbank business, corporate business, commodity business can substantially increase. My investment business itself can substantially increase. There is substantial volume growth in treasury. The treasury volumes are increasing. So that is possible because of the technology. Manually, it could not have been happened. As I said, what are the regulatory expectations? We expected what Treasury expects from technology, but I also mentioned one word there, that regulator is interested in that, because basically there is a possibility of a systemic risk because the amounts involved are large. So there is a regulatory expectation on technology. What is the for regulatory entities, like for example, banks, insurance companies, etc., etc. One is some functional separation, we understood, back office, front office. Exposure control management, like for example, limit on the position, overnight limit, intraday limit, counterparty risk limit, the gap limit, variety of control limits. All those should be manageable through the treasury technology. It is not that somebody takes a big ledger and writes it and updates it. It has to take place at the simultaneously. I have put through a transaction, I have given a loan of in the interbank market, I have lent, for example, for 50 crore rupees to a X bank. Already my exposure gets updated. If the total exposure limit permitted by the bank, by the management on that bank is a 250 crores, if the outstanding amount should immediately get updated by this 50 crores transaction, so that I know what is the remaining amount available for putting through further transaction of different types. So the limits get updated continuously. All that are possible only through technology, and regulator definitely expects that to happen. Obviously, of course, it's all happening very clearly. Uncontaminated reporting. That means basically the regulatory report should be very accurate. It's not that the management or somebody in the treasury makes some corrections and sends it, etc. It should get system generated, and without any human intervention, it should go into the regulator's inbox directly, so that regulator can observe it very clearly. Close oversight, in the sense, oversight. What means the inspection, or so-called, the earlier type inspection or audit does not happen. It's all done what is called as an off-site surveillance. That means, sitting at a central office, sitting far away from the actual place of treasury, that regulator or the auditor should be able to have a very close oversight on the activities and monitor and ensure whether it's all happening as per the laid down policies and procedures, etc. Such closely observing the technology should make available, or technology should facilitate such observation. Accounting accuracy, of course, it is not simply that accounting accuracy we think about usual original tally software and all, not about 2 plus 2 is 4. Not that. In a treasury, for example, in the greatest challenge in accounting is about the valuation. For example, what should be the valuation, what should be the rates to be accepted for valuation, how to capture it, what are the policies for valuation, is it a conservative policy where you ignore profit and account for losses, etc. All that, or it may change from year to year, year to year. How do you capture all that, and how does the technology very accurately accounts for all that? That is what the accounting accuracy that is expected of. Maybe regulator may change the rules, and it should be possible to update it in the system. Regulatory compliance in all areas, that is what the technology should support. That's what a regulator expects in the technology being adopted in a treasury. Having mentioned that, a couple of more specific points for you as an auditor, if you are into audit business or for those who are interested in that. I'm not talking about a general audit, but audit as relating to technology in a treasury situation. One, as you may be knowing, these are all RBI guidelines for banks I'm talking about. We'll talk about is NBFCs also a little later. Or specialized branches like, for example, SMEs, corporate branch, this or that, etc., or including treasury, should necessarily be subject to concurrent audit. Mind you, this increases the scope for audit substantially. Banks should conduct an information system audit on an annual basis on all its on the system that is being used, on the automation software that is being used. Such audit should take place, the statutory audit before the statutory audit, so that the information system audit reports are also available to statutory auditors, so that a holistic view can be taken by the statutory auditor. These are some of the guidelines given by RBI on the technology audit, including in treasury. Even Government of India has issued some guidelines on that, of course, in the year 2012, but then subsequently to not. But it indicates, for example, the seriousness involved. In fact, government made a statement saying that present audit system is behind the technological advancement. This sentence was told in 2012, but maybe, at least partly it may be true even now also, which means you as auditors, or some of you who are auditors, you have a greater responsibility to see whether our process is catching up with what is technological advancement that is taking place and all. Should give adequate attention to IS audit, which is mentioned earlier. Guiding principle IS audit, for example, it gives some guidelines. For example, what are the guidelines applicable for IS audit, etc. Continuous IS audit should be introduced in critical areas. Assessment of internal resource improvement. This sentence may be interesting to you. Banks should have a separate IS audit team with persons having CISA qualification, IT experience, etc., qualified professionals. It means something like a combination of knowledge in technology, knowledge in IT, knowledge in audit, technology audit, etc., etc. So that type of expertise is expected. RBI expecting is, government is expecting, etc. So that means the treasury technology is a sort of a ripe area where there is lot of involvement of auditors is expected. For NBFCs, there are some other guidelines similarly. For example, an IS audit should form an integral part of it. Similarly, what I mentioned, in particular, for example, RBI recognizes the guidance given by professional bodies like ICAI. ICAI has published a document called Standard on Internal Audit 14. Many of you perhaps are already familiar of it, but what I want to mention it here because RBI specifically said that is one of the guidelines to be followed in the technology audit for NBFCs. Should order IS audit framework policy, board approved, etc. Skilled personnel should be available in the audit committee who understand results of the information system audit, etc. So this document, if you are not familiar, this is the document which I mentioned there, which is available on public platform. If you are not seen, obviously you should necessarily possess it, go through it, be very familiar with that, because that gives a complete idea about, for example, what is it actually what we looked at for in case of a technology audit in a NBFC. Having understood, perhaps we will talk about a little bit more on what's called as a fintech. What we talked so far is about the treasury in general, what's the concept of treasury. Then we talked about can we manage a treasury without a technology? I mean, a hypothetical question. If technology is being used, what are the implications and what are the sort of control guidelines we try to impose so that the technology does not become a sort of like a wild dog. It becomes a domesticated dog, meeting the requirements of all the owners, all the household personnel. In the sense that all the stakeholders are adequately serviced by the technology. That's what the expectation is by the regulator, by the stakeholder, by the management, etc., etc. Having understood that, we also talk about a few other concepts which are having presently, for example, during last couple of years, presently are making lot of impact on the technology that is being adopted in Treasury. One is concept of a fintech. I think all of us, 100% all of us have heard about fintech. At least around 90%, 95% of us know about fintech, what is fintech, but balance 5% obviously can easily make out what is fintech, which is basically finance plus technology. That means basically intensive use of technology in finance area. Intensive use of technology in finance area. Okay, you go to any bank branch, everything is automated. There is a CBS, there is either a Finacle or some software is being used. Then what is it actually fintech is doing? It is something more than that. What is more than that? Of course, a very casual definition of fintech would be it's a driver of disruption. Why do you call it a driver of disruption? Fintech makes things much different than what is routinely happening. Different in what way? Different in a way which modifies, enhances or automates financial services or for businesses and consumers, essentially to make it functionality easier. That means if you are a consumer of a financial service, if you are, for example, if you are availing a home loan for your proposed house, if you are a corporate availing, for example, a finance for your receivable financing, or for example, any such trade activity, bank offers a technology enabled some solution, agreed. But can it be made available in a much simpler way, simpler from your angle, your perspective, from a consumer's perspective, can it make it much easier? So that is what fintech is tried. Fintech is aimed at. I mean, a lot of applications already available, made in the form of an app, etc., etc. Initially, fintech was a competitor for banks. Banks did not like it because it was making things easier. See, remember when efficiency increases, things become easier, there is obviously there is a possibility of hidden profit getting lost. So obviously some banks were not happy, they were treating fintechs as competitors. But of course, when it became very popular, when the consumers were demanding, when the customers were asking, yes, this fintech application is very useful to me, there is no alternative, so banks started collaborating. Some banks started their own fintech subsidiaries, etc., etc., all existing financial service providers. Newer functionality impacts the design of Treasury Group. In fact, fintech's new functionality impacts even the Treasury design itself. We will try to understand what are the possibilities. Treasury management software itself now includes not only the functional support to the Treasury, but also the technological support. I mean, so not only technology support, even the functional support, in the sense how exactly to offer a technology, the Treasury product in a customer-facing situation in a simpler way. To tell it in simple English, a Treasury may be offering a forward contract facility to customers, which is the simplest thing. I think all of us know about what is a forward contract. So Treasury is offering, but in a traditional sense, a corporate was expected to talk to the branch manager. Branch manager will talk to the Treasury and tell what are the possible rates and what is advisable, whether to book or not book, etc., etc. The typical dialogue goes on. Now the same thing perhaps can be made available by the Treasury to the trade manager of the corporate through an app, and the app will tell you today, if I book the forward contract, these are the possible profitabilities. If I don't book it, these are the possible risks, and this is the cost of risk, etc., etc. If it gives a complete sort of comparative matrix, I will be able to take a decision without a further discussion, etc. I find therefore this as a very useful way of handling forward contract. So that means there is a sort of a fintech, a technology intensive application has been offered by the bank now for this purpose. That is what a simple, a crude example of a possibility. So offering trade management software offerings now include all this technology and functional perspective itself. Those of you who are working in corporates which are engineering exports, I mean, something like a Larsen and Toubro, for example, engineering export company, if you are working in that, big or large, big or small, in all probability, your company will be a member of an organization called EEPC, Engineering Export Promotion Council. If you are a member, if your company is a member, your company gets a magazine called as Indian Engineering Exports, IE2. It's in a monthly publication. Earlier it used to come on hard copy. Now for the last 1.5 years after this virus problem, it is coming as a soft copy. I have published a large number of articles in that. If you have that, if you are working in such a company, if you are interested, you can see, for example, one of my articles about a year back was on banking and fintech, whether it's collaborator or competitor. It is not a very great article. It's a very sort of what is called as zero-based article. For those who are completely new, perhaps this article could be useful. I mean, it's not publicly available because there are copyright issues, etc. But if you're a member of, if you're an employee of such a corporation, perhaps you could read it. There are a large number of such articles which are relevant to Treasury. My articles are there. You can see it. Fintech and Treasury, which I was talking about, perhaps we are talking about what are the possibilities, the functional, technological perspective, etc., etc. What are the possibilities of a fintech in Treasury? For example, there could be peer-to-peer platform. Peer-to-peer platform is perhaps some big English word, but many of you have heard about what is called as a TREDS, TREDS. What is TREDS? Basically, trade receivable discounting scheme. That means if you are, let us say, think about it, you are a furniture supplier company, manufacturer and supplier. You have supplied furniture worth 5 crore rupees to Infosys, and the payment is due after 90 days. And in a normal course, you go to the bank and discount that bill, and then bank gives you money at rate of interest of X%, let us say 7.5%. It does not matter whether the bill is drawn on Infosys or some Faltu limited company. Faltu company limited. So rate of interest is already fixed because it is a part of sanction letter. But now in under a trace, what you can do is, I mean, if you are becoming subject to documentation, becoming a member, etc., you can put through that details on the platform, and then some other bank, because in the normal course you can't go to some other bank because you have held a cash credit from your existing banker. You can't, basically from legal angle, credit discipline angle or a loyalty angle, you don't go to some other bank. But now that has been officially permitted in a TREDS platform. There are a couple of platforms, active TREDS platform available in India. You can put the details on the TREDS platform. Some other bank will say, I am ready to lend it to you at 6.95%, because basically for that bank, the debtor is an acceptable company. Infosys is unlikely to default on the due date. So the risk is very minimum. It is something like a AAA corporated bond. So the bank is ready to give it at, because it has surplus funds. So without disturbing any of your existing bank relation, you can go to a third bank and then acquire funds and ask them to send the funds to the cash credit account with your existing banker. I mean, it's a simple example of that. There are many further advanced possibilities. Obviously, this does not work without a technology. And why we are talking about this? Because basically, as a corporate treasury, therefore the liquidity management becomes easier. You remember about that, optimizing the minimizing the cost of funds. So here you are able to minimize the cost using technology is sitting in the treasury. That is why I gave this as an example. Crowdfunding, for example, you heard about it, and I will not talk much about the crowdfunding. This basically, it talks about what is how to raise funds, etc., and all. Trading of financial instruments, payment and receipt options, cryptocurrencies as a medium of exchange. We will talk a little bit of it a little later. But basically, this becomes a new asset class, or could be not so officially a medium of exchange also, not only as a digital asset, but as a digital currency. Second part has not yet been approved in our country, for example. Streamlining, even the first part itself, but first part possibilities there, second part doubtful. Streamlining existing process across key sectors, etc., like for example, managing multi-currency bank accounts, automated payments, collections, FX hedging, risk management, etc. Digital and global requirement of a corporate treasury. For SMEs, for example, many of the SMEs do not get proper corporate advice from a banker, because a banker or a financial advisor, because the amount involved are large. Whereas if, for example, if the fintech does not distinguish between a small amount, large amount, or a small borrower, or SME or a corporate. So if a fintech application can help in getting the best advice, like what is required by a large corporate specialist needs, etc. A real-time P&L can get generated, in the sense, as soon as I put through a transaction, the fintech can capture the ongoing market rate, and then therefore it can help in valuing and providing an updated P&L. So that's what it could mean. It could help. But later, these are all possibilities. Some are already happening. Something like an algo trading, if you heard about it, or if you are familiar with that. What is algo trading? Algo trading, what is algo? Algo stands for algorithm. That means basically, instead of A person sitting in the front office of A corporate or a bank dealing, buying or selling with the treasurer B of B corporate. For example, whether a computer sitting in A can, after all there is a connectivity, can deal with the computer versus B and then put through a transaction. Okay, that means basically, can treasury be fully robotic? Can there be some, can it happen without human beings? Right now we feel like telling no, but then it is not completely ruled out. SEBI allowed algo trading in 2008 itself. Initially, institutional investors and retail segment retailers recently started participating. Of course, there are a lot of issues, lot of challenges, some restrictions have been placed in, etc. But then it is possible. What fintech firms are presently doing is, in fact, 2008 the SEBI allowed. Fintech came into picture or became very active in Indian market only during the last few years, much later than 2008. But then fintech firms started offering APIs, the application protocol interfaces, where it can, the two applications, one in the vendors software and one in the trading platform trading platform, and the software sitting in your system, you as a corporate or individual can talk, that this interface can facilitate. You can write your own codes or your own algorithm. You can say, okay, I want to buy 100 equity shares or 100,000 equity shares of so and so company limited at this price in the next 15 minutes if the price is received, something like that. And also you can build in a condition about it, only half of this at this rate, etc., or perhaps and should be sold at this rate if the price movements, etc. All that algorithm you can write it, or from there are a lot of existing strategies, existing algorithms available, you can choose and trading can strike place. Afterwards, what happens, you are giving an instruction to the machine. It's not that the machine has started thinking. We have not built the artificial intelligence or market machine learning into that. We have built an algorithm and given. That's the first stage of machine doing instead of I actually activating it to do something. So it gives some sort of standing instruction. It puts through that. Globally, in fact, this is about the SEBI has done. Mind you, RBI is not allowed. In the foreign exchange market, it's not allowed. But globally, execution of this well established in the cash equity markets and are also increasingly being adopted in foreign exchange market. That means there is a possibility it happening in foreign exchange markets also, if not now, at a later stage in India also. There are a lot of exchange control regulations. As you know, the foreign exchange market is much more regulated than perhaps the other markets. There are a lot of, because there is a movement of funds. Once the funds go out of a country, it's impossible to get it in, or it may be very difficult to get it inside into the country. Reverse movement control goes up. So obviously, there are a lot of limits, ceilings, purpose-wise, quantum-wise restrictions, etc. in outward flow of funds. So all those, they are restrictions. Therefore, the algo trading has not yet happened in foreign exchange, but then in equity market, perhaps it can happen. But globally, it is slowly being happening in foreign exchange market also. Not only machines are putting through the transaction, a sort of AI or ML is being built in. That means basically the machines start predicting what is the likely movement of, say, for example, sterling versus dollar, the cable movement in the next half an hour. So if the machine thinks that, or because of the logic it has developed, or because of the AI, because of the machine learning, if it thinks that sterling is likely to strengthen, perhaps the machine will buy for sterling, and it will create a overbought or a positive position in sterling and try to offload. In all probability, its thinking will be very similar to what a treasurer sitting there would have thought about it. So maybe the machine will make almost same profit, same quantum of profit, or same extent of mistake and losses as a human being would have done. If over a period of time, if the machine performance and a human being performance are very similar, most corporates would prefer to go for a machine. Because machines are reliable, there is a consistency. Machines are much more reliable for execution and for example the consistency. You can control it much better than a human being control. You can understand the machine thinking. You can manipulate the machine thinking rather than a human being's thinking. Who knows? For example, this trader is telling like that, and is putting through large transactions on 31st March valuation. I give a large bonus, and then he resigns on 1st April and goes. Whereas the machine does not. It does not require extra bonus at all linked to the amount of profit it has generated. So the machine price, the salary of the machine is constant, whereas the salary of the dealer is linked to the bonus, or the cost to company of the treasurer is linked to the profit he makes. So it becomes much easier to take a robo rather than a person. So it can happen like that even in India. So imagine the role of technology. On all the obviously algo tracing is happening through a machine. So actually there is nothing like a role of technology. It's all fully technology. Maybe if we are holding this discussion, say 5 years from now or 10 years from now, the question would be, for example, instead of saying can treasury be fully robotic, the first question would be, can treasury be fully run by human beings? So that could be the first question. And the last question would be, hey, imagine the role of human beings in treasury. Something like that it can happen. So the beings are replaced in routine activity. Earlier, human beings were replaced in routine activities by machines. Now, even where some thinking is involved, machines are taking place. Machines are replacing it because of the ML or AI. So that is what it is. Where to draw a line is a question of time, and obviously there is nothing like a mathematical answer for that. Having said that, having talked so much about treasury, obviously the scare part of it is about the treasury security. Obviously, you heard about all that. Even in the simplest technology situation where we are using a Google Pay account, there can be a fraud. Where internet banking is being used, there can be a fraud. So those things regularly get reported in the newspapers. But the fraud that is happening or the hacking that's taking place in treasury technology does not get much reported. Page 3 of a newspaper does not contain much about the cyber security issues in technology. But as you can imagine, that's why I give 2 examples. So I think at least one example is familiar to all of you, which talk about the operational risk arising out of technology in treasury. Just for information, what is operational risk? Earlier we talked about market risk. Market risk is risk on account of variations in the market parameters. Like for example, interest rate fluctuation. You have put a fixed deposit of 1 lakh rupees in a bank at say 7% interest for 3 years. Interest rates have gone up to 8%. There is a notional loss for you, but that is something on account of a rate and change in rate of interest. It is not because of any mistake you made. It is because the market fundamentals have changed. I mean, that's a crude example for an individual. Similarly, for an interbank market or for an exchange market, etc. So that is all about the market risk. We are talking about what is operational risk. Risk arising out of operations activity, like for example, on account of technology, on account of frauds committed by the staff, some system failure, some legal risk, etc. They are all typically operational risk. All types of financial risk can be classified into 3 categories. One is operational risk, what we talked about now. Another is about the market risk, which you talked a little earlier. Third is, of course, the credit risk. There is something like a counterparty risk, or the default, or the non-payment, or the non-adherence to terms and conditions by the counterparty. It includes, for example, something like a country risk, etc. All of them are credit risk, market risk, and operational risk. Treasury is the sole proprietor of market risk. Operational risk can happen anywhere, treasury or non-treasury, but mind you, the quantum of loss that can happen, the extent of risk in case of operational risk in technology, in treasury, is much higher, basically because the amount involved are large. I give 2 examples, perhaps then we'll leave it at this, because this is a great subject by itself for discussing. One, a large public sector bank lost over $2 billion. If I tell the rupee equivalent, immediately you will be able to realize, on account of fraudulent letter of undertaking. I think once I mentioned the word LOU, I think many of you will recollect. And to give a further confirmation or hint to you, it is about the jewelry business of a couple of corporates sitting in Mumbai. For overseas for availing a overseas credit, fraudulent letters of undertaking were issued by the bank, or rather got generated from the bank, and then their overseas remittance module SWIFT was not linked to CBS. What had happened is, there was a series of letters of undertaking were issued by the bank, unauthorized. But what is more important is that unauthorized issue did not get triggered, it did not get escalated, nobody noticed it. Why? Over a period of several years. Why? 2 things happened. Number 1, the resultant overseas remittance module, which is happening through SWIFT, So Swift module was not linked to or integrated to the CBS of the bank. So what happened when some remittance under this LOU happened under Swift, it did not get resulted in debit to the customer's account, as simple as that. So that means basically it is not a great method of doing a fraud. In fact, it is not a very intelligent fraud. But the fraud happened because there was a gap in the technology. And of course, the second reason was that the same person was doing, remember, 2 eyes, 4 eyes, 6 eyes, all that were gone. This one person had borrowed the 2 eyes of the supervisor, the checker, and he had also borrowed the 2 eyes of the authorizer. So he effectively had 6 eyes. So it happened. Again, a very simple, crude way of fraud. It is not a very sophisticated fraud. The person was not transferred from the department for 7 years. He was doing the same place and all people believed him. I don't know what reason. And of course, the technology, there was a gap and this loss happened. Of course, then a lot of post-mortem took place. That's a different issue. A lot of auditors were questioned, etc. We will not go into that. But then it related to the remittance. Therefore, it was related to remittance in foreign exchange, resulting in foreign exchange loss to the country, etc., etc. It affected the treasury of the bank. So treasury technology was involved to the extent that there was an obvious gap which was not filled up. Obvious post facto, it looks like an obvious common sense gap, but it had happened. At that time, it was not a common sense gap, but now it is a common sense gap. Second example, some of you may be familiar, some of you may not familiar. There is a bank called Bangladesh Bank, which is a central bank of Bangladesh. It is a counterpart of Reserve Bank of India. And funny thing is that bank lost $81 million in cyber attack. Now think of it. For example, if the Economic Times were to give a heading, it won't happen, it should never happen, it won't happen, saying that Reserve Bank lost $81 million, it would have been a very we feel very sad about it, bad about it and all. That's what happened in Bangladesh. In fact, the governor of Bangladesh Bank resigned, etc. It's around 7 years ago. You can put this one sentence in Google, you read it, it's very interesting. What had happened is, there was in its system, again in the system network within the bank, something like a gap between SWIFT and CBS in the first example. So between two systems, they were not fully integrated. There was a patch which had been done, and through the patch, the transfer movements were happening. Some outside hacker observed it electronically. He took advantage of it. He attempted up to $1 billion. Fortunately, balance amount did not move out of the Nostro account of Bangladesh Bank because there was some error in execution, etc., spelling mistake, etc. But then 81 million went through and the bank really lost that amount. A lot of investigation. One of the investigation report was telling the bank had purchased some, usual roadside available made in China product or something like that. Some $5 product, they had done it and then patched it and the two systems were talking to each other. It was going on very smoothly. It has not integrated robustly. That was the issue. So again, it is not a great way of hacking, but then a very simple way of causing a loss to the treasury of a bank through the fault or a gap in the technology. So I thought I will give these two examples. And why this is important is they are the cyber security issues of treasury are much more critical because the amount involved are large. And once, for example, in the second case, what happened is the money went to Philippines. One small amount went to Sri Lanka, which was recovered, but major part of $81 million went to the Philippines. And from Philippines, the customer there took the money to, for example, North Korea and China. They were Chinese origin people in Philippines. They're doing all this, and then took it away, and there was no way to recover. Bangladesh Bank could not recover it back at all. So the cyber security requirement, treasury are much more critical from that perspective. Amount involved are large. Many times it becomes irrecoverable, etc., etc., and very niche. Because after all, there are some, say for example, 2 lakh branches of banks in India. All of them are using software. So there is a replication of possibilities. If there is a problem or a fraud happened in one branch, perhaps immediately it gets circulated. All others can learn from that example. Whereas there are only around 100 banks in this country. That means there are only 100 treasuries in this country. So if there is a problem, it becomes so unique that everybody has to learn. By the time it learns, the new fraud type will take place and all. So that means it becomes very niche. The transactions of treasury are very niche. It's very unique by itself and all. So that is why, in fact, the security requirements are very critical and niche. So we talk a lot about the security, the technology as applicable to treasury. We should also know the gray area part of it, where one should be careful and all. That's what it is. We talk about something new. We talked so much about now, in fact, the challenges. But of course, we have more challenges to come in the near future. We talk foreign exchange securities, the non-digital security like money market instruments, equity, share, debentures, etc. All of them are tradable instruments in treasury market. But now new types of new class of assets are coming. They're called digital assets. For example, bitcoins, variety of alternatives, non-fungible tokens, CBDC, central bank digital currencies being issued. So they're all digital assets. So that means that basically it is held by the technology and it is used by treasury. Many of the treasuries, for example, Bitcoin technology characteristics makes it ideal for a diverse, because corporate treasuries, even bank treasuries, look for diversifying the portfolio into assets which are of course which are legally allowed. As on today in India, for example, digital asset like Bitcoin is not a legally allowed investment where one can invest. Like a bank cannot invest, or NFT is not an investable, legally allowed investment instrument. But then it is not very far away. There are countries which are already allowing such instruments. That means that treasury, the portfolio gets diversified. The technology has to take care of it. Taking a hedge against inflation, perhaps because Bitcoin the prices are fluctuating. Treasury thinks it's a good instrument to hedge against inflation. More and more regulatory clarities are coming, sort of infrastructures are coming, and the regulators saying, okay, it is acceptable. So digital assets are evolving. In fact, the holding is increasing. IFRS does not give specific guidance on that, not connected to technology, but I thought this paragraph may be interesting to you. Treasury technology should be able to hold, facilitate, trading it should facilitate, valuation should be possible under these evolving situations, etc. This is what the expectations of technology when these new class of assets are coming. Again, as I said, there is another article I wrote which published in September 2021. If you are a member of that any company, if you are employee of a company which is engineering export, a member of EEPC, look at this. It gives a basic idea about what is CBDC. Of course, it is not great. As I said, there are lots and lots of articles available in the market. This is one such article. Otherwise, also you can see it. It's a topic which is gaining importance because RBI is likely to issue the CBDC, the digital rupee, in the next 1 year or so, next financial year. Having said that, these are examples, because there is one country called El Salvador. I mean, many of us would not be very familiar with this country, but that is one country which has officially allowed its treasury to buy bitcoins. Bitcoin has become an acceptable acceptable asset class for the treasury. The president of that country himself made a statement about it because he thought it is something great. NFTs are coming into the treasury, establishing use case in trade finance, etc., etc. These are all evolving. Mind you, these are all evolving situations. It is not that it is all it has already happened, but it is evolving. But then in the next few years, perhaps if we have this discussion, say 5 years from now, some of these will be in past tense rather than in the future tense. Bitcoins, the treasury implication, for example, these are all articles available. You can see it. What I wanted to say is, so there are very clear indications in the market that bitcoins or NFTs are all likely to become asset classes where treasury will diversify, which means all the implications of treasury implications should therefore become interesting for all of us as treasurers, because this is what I wanted to tell you, because there is no point in we academically understanding all about technology, all about treasury, what treasury does, etc., etc. They are all for academic purpose. We are not here as academicians to write a research article on technology and treasury and what it can do, what it cannot do, etc., etc. Let us be very clear. We are a bit selfish. So what is it there for me with all these developments? So what is, if as a finance professional, if I'm taking up audit, what is it actually which is of interesting to me of these discussions? That's what we should know. What is my role or what is the scope for me? As I said, one is concurrent audit in treasury and forex handling branches of banks. If there are only 100 treasuries, okay, there is fine 100 opportunities for treasury audit. But mind you, there are 2,000, 5,000 branches of forex, foreign exchange handling branches of commercial banks. All of them require concurrent audit. That means you are welcome there. The scope is very large. There is a scope for audit. System audit manually. And mind you, in all these places, you do the audit through the technology. It is not that like decades ago where somebody will produce a large books of accounts. You through it technology. That means you should be familiar with the technology. You should be familiar with the strength of the technology or the loopholes or the gaps in the technology also. if you can suggest improvements in the technology, perhaps the client bank or client organization will be very grateful to you. System audit is annual mandatory in regulated entities. Even others also would welcome regular audits. Ground rules are evolving. Ground rules relating to all these are evolving because new asset classes are coming, new technological implications are coming, etc. The goalposts are changing because the expectation, the profitability, types of instruments, they're all changing. The growth numbers are growing. So that means here is a very, very dynamic situation. The floor is not steady. The roof is in fact is expanding and the length is increasing. So it's a very, very sort of, that the universe is expanding. That means auditor has to be on the toes and all hands are always full. You can't even rest for a minute. Not only in your audit work, more importantly, auditor has lot of work on hands full in updating yourself. At least some of you, for at least some of the slides, would have given you some ideas on thinking. That is the learning curve all of us are on. So that means basically our hands are full, not only in our work, perhaps I should change the word instead of saying hands are full, our minds are becoming full because in the sense there is a lot of scope for activating our mind. So a combination of a system audit, for example, a CISA qualification, a forex expertise, for example, something like a FXTM exam or MBT exam of MBF exam, etc., of ICAI, etc. They all add to the treasury part of the foreign exchange treasury management, treasury knowledge of the system audit through CISA, for treasury knowledge through these qualifications, and you fundamentally as a chartered accountant with all the knowledge about the accountancy, perhaps it's sort of what we can call as a sort of deadly combination. It's a culmination. It's a pinnacle of success. So there can't be any sort of boundary. People look to you for every angle. Regulators, even the government, I showed you, look for people with such comprehensive knowledge. When I test the accounting knowledge as a CA, the audit knowledge as CISA, technology audit knowledge as CISA, forex expertise or treasury expertise as FXTM, etc. That will make you a sort of real success. Opportunities are therefore opportunities galore. You have huge opportunities outside in the field. So if you are thinking vaguely about treasury or treasury audit or learning treasury, I think that is a great occasion to strengthen that, think further on that. Having said that, I think our time is also ending up. So I would like to wish you all the best for building up a wonderful career in this area of treasury plus technology combination for the next year for the current year and future. Hopefully disease free year. See, the year has started fairly well. In fact, unlike the last 2 years, year has not started, at least for so far, is not started gloomily. Lot of positive things are happening in the market. Disease numbers are coming down, etc., and all. It looks like we have a great future. Perhaps you should take some great steps for that. So with that, I would like to wish you all the best and thank you all. And we are almost on time, maybe a couple of minutes this way or that way. And madam, perhaps I end with this session. And obviously, whatever, if there are questions, answers, I would like to. And I don't guarantee that I will answer you, but if I know the answer, I will definitely answer you. And I think there could be some difficulty in getting the questions, etc., the technology related, and perhaps she will help in getting the questions and asking me and then sending back the answer. It is for you, madam, now.
Yes, sir. Thank you for this wonderful session, sir. And I'm very much sure that all the participants who are present here actually have taken so much from this session. Actually, before the conduct of this session, I was also unknown about the topic, that is treasury management and technology. But me myself has taken so much from this knowledgeable session and intellectual session. And sir, you have explained it so very well with your crystal clear examples that I don't feel so anybody would here left with any kinds of the doubt. And it is very much true to say that humans are going to be replaced by the technology very, very soon. And sir, and one more thing I would like to say ki, like you have said, dil mange more. So sir, I want to know something more about the NFT actually. The non-fundable tokens actually, if you would like to.
Non-fungible tokens.
Non-fungible tokens actually.
Yeah, correct. Okay, I will take bit liberty with you. Let us say I am a good painter.
Okay.
I draw a beautiful picture of yours on the system on
Okay.
here. And
Okay.
all the participants think that is the best picture that is available, almost next to Mona Lisa. So that
All
means there is
right.
a lot of demand for the picture.
Yes, yes, yes,
I,
totally.
I'm giving a very crude example and a very simplified version of it. And there is no way where you can replicate it. You can take a color photocopy of it. And if a participant is actually really sort of a expert in this, he or she can distinguish between the original and duplicate. And
Yes.
obviously, the original painting which I have
Hmm.
has lot huge value. Its
True.
value can fluctuate. In a treasury,
Yes.
in a market, free market, we know there can be fluctuation in price. So
Yes,
similarly,
yes.
for example, any artwork, a
Hmm.
digitally developed artwork, for example, its ownership can be established. It cannot be changed because what I am going to do is I am not going to put the picture or the artwork on a routine MS Word or anything such software. I am putting it on a blockchain so that
Hmm.
it is accessible to all, which also means
Okay.
nobody can alter it.
Okay.
So that
Yes, yes.
it is a unique art. So it means
Hmm.
it is non-fungible.
Okay, okay, okay.
So it
So
does not move
basically,
from
this
one
is
person
totally relates to the art.
generally to the art. But then
Okay.
it started with the art.
Okay.
Now it can go to anything else. For example, I'll tell you a simple example. Again, it is a very hypothetical example.
Hmm.
I have you talked about, say, for example, I have, let us say, a, a receivable. For
Okay.
example, 100 rupees. Let us say I have to receive 100 rupees from from our Prime Minister Modi.
Okay.
So in fact, because I am his relative or friend, etc., I have
Hmm.
lent him 100 rupees, and he has given a IOU, a sort of promissory note saying that I promise to pay you 100 rupees, etc., with his signature. Now,
Okay.
do you think, and that is a digital signature, let us say it has
Hmm.
been put digitized. Do you think it is worth 100 rupees or it is much more than 100 rupees? Obviously, it is much more than
Not
100 rupees.
much more, but of
Nobody will
course.
want to go to him and encash it because its market value will fluctuate.
Yes, yes, totally.
Fluctuates, it can increase anything. So that means here is a digital. It is not an art. It's a digital receivable. Is
Okay,
it
okay, okay.
fungible? For example, can somebody alter from 100 rupees to 200 rupees? No. Can it
Hmm.
change from Modi to somebody else? No. It is digitized. It is put on the distributed ledger like blockchain so that it can't be altered at all, etc., etc. I don't
Hmm.
understand how it happens, but then it is what it is. So
Yes,
you
yes.
asked a question. It is relating to art. I tried to give a very hypothetical, crude
Yes.
example of it. Now you
Hmm.
remember that instrument is a trade instrument. It is an instrument where treasury people are interested. So I tried to give an example of a treasury
Hmm.
instrument becoming an NFT. Very
Bilkul.
hypothetical, maybe lot of flaws
Hmm.
in my argument. For your
Hmm.
example, I told.
Yes,
So this
yes.
is what it is. So there are digital assets coming where treasury people
Yes.
are interested, which requires technology support. So all the participants who are like to become auditors, I think you should become much more than a finance professional. You should become a
Yes, true.
great technology personnel also.
Very true, sir. Now this is the actually the demand of the time.
Yes.
Yes, sir. Now I will go through the questions if there would have been any from anyone. So, sir, there is a question from one of the participant that has any entity implemented blockchain for treasury management?
See, treasury management blockchain, for example, not in treasury management, in trade finance, some banks have implemented. For example, ICICI Bank, HDFC Bank, even many of the new private sector banks, or none of the public sector banks, have started experimenting on blockchain technology. And mind you, blockchain technology as such is highly legal, no restrictions, regulatory problem, etc. On Bitcoins, there are a lot more, but
Yes, yes.
blockchain technology is something very routine technology. Banks have started using it. I am not familiar, sure about the corporates, but couple of these new
Hmm.
private sector banks for their trade finance they have definitely started.
Okay, okay. Sir, we have got so much feedback from so many participants here. Like this is a wonderful session, and so many another comments and compliments from our participants. And there are no other questions from any participant here.
No, no, no. But that is not okay because people don't ask questions either they have not understood anything or they have understood everything. So my fear is the first point.
No,
But
sir.
anyway,
Session was
I
so
will.
intellectual, and your examples were so crystal clear and so much knowledgeable and understandable.
Okay.
I don't
And
feel
anyway,
so.
you can't ask questions. So thank you. It meets the requirement. I am happy with it.
Thank you for your deliberation, sir. So now I would like to invite CA Hiren Jogi, sir, the Vice Chairman of Kola branch of WIRC of ICI, to deliver the vote of thanks to Shastri, sir. Over to you, sir.
Yeah, thank you, ma'am. Good evening.
Thank you, sir.
First, I would like to convey my sincere thanks to the Committee on Management Accounting of ICI for having this session for our branch. Thank you, CCM CH Charanjit Singh Nanda, sir, the chairman of the committee, and CCM CA Hegde, sir, the vice chairman of this committee, for allotting us this topic. I thank the speaker, Mr. T. R. Shastri, sir, for delivering such a fantastic session. It was new for most of us, sir. The session has enriched us all. We hope for many new, more great sessions in the future. Also, thanks to C.A. Srishti Khanna ma'am for moderating the session. Last but not the least, my gratitude towards all the esteemed audience for their presence, their valuable time. I am sure we all have learned something new today. Thank you very much and good night from my end. Thank you.
Good night.
Thank you so much, everyone. I'm very grateful to be the part of this session. Thank you, Shastri sir, once again. And now I may seek the permissions from all the deliberators here so that we can end the session. So yes, sir, thank you once again.
Okay. I log off.
Thank you, Rin sir. Yes, sir.
Thank
So
you.
good
Thank you.
night, everyone.
Good night. Good night to all. Good night to all. All the best.
And a very good and great time to all of you. Thank you.
A great session. Thank you.
Thank you.
Recording has stopped.